So in this cyclical environment, Lynn, what are the asset classes you look at for places where to hide? There are not many. If you look at year-to-date returns, they're pretty bleak across the board.
Generally, I like a combination of energy producers, energy transporters, healthcare stocks, gold, cash equivalents, kind of the middle of the curve, maybe 2-year treasuries, things like that. And then I do have some barbell, like I have Latin American equities, I have Bitcoin, I have a small number of kind of these network effect growth stocks, right? Very small positions. So I have some of a barbell going on, but I'm kind of weighted towards kind of defensive value and ones that are not heavily tied in the supply chain and basically some liquidity in order to rebalance into any sort of downturns you might have.
Lyn, what are the signs that you would be on the watch for to turn around on that thesis?
One would be basically improving rate of growth metrics, right? So, maybe an opening of China. We're starting to maybe see that some of these extreme lockdowns are easing. They might have already hit peak lockdown, and that they're maybe slowly coming out of that peak level of lockdown. But I think that could also potentially exacerbate inflation because that means more demand could be opening up if China kind of starts stimulating a little bit. That could actually impact inflation, and so really it's kind of watching for changes in the growth itself. And so I think I would look at signs of how much banks are lending and things like that. And that's why I'm not completely devoid of risk. I think, I would kind of balance it based on what's happening. And then right now, until I see evidence to the contrary, I like that somewhat defensive positioning, but it's not like a super bear, like, hardcore bear, don't own anything that's risky type of a portfolio. It's just a waiting.
I had a discussion with Michael Gayette earlier this week on whether it makes sense at all at any time, a point in time in history, to be cash loaded as a private investor. My answer is no. Do you have a view on that, Lyn? Does it make sense to be cash loaded at any point?
I think probably not. I think there are times to have a little bit more cash equivalents than others. Basically a little bit more rebalancing fuel. You'd have to have a pretty high conviction view on both direction and timing in order to have a lot of cash, right? So, maybe if you were, for example, one of the people watching the subprime mortgage crisis and had a high conviction was going to blow up in the next year or two, having a lot of cash would be useful there. But other than that, I think that generally cash is kind of designed to lose value over time. And I often joke that it's kind of the one speculative asset I own because it's the one thing I own that I know is going to get worth less over time, but that I still own some based on the speculation that some of the things I actually want to own might get cheaper, and then I might be able to rebalance into that. And so it's all about a percentage in my view. Now, if a trader, it's obviously also different between a trader and an investor. If someone's a trader, they can go to a complete cash position until they kind of realign what they're looking for. Whereas if you're actually just a long-term investor, I think that there's no reason to ever be 100% cash or massively cash.
Yeah, it's a very good point. Actually, cash, you can see that as a relatively expensive optionality from a real rate perspective. So exactly, inflation keeps on eating you away, and the time value of that also compounds against you. So it's a relatively expensive optionality, but owning some of it depends from your risk tolerance. 100% cash is quite an interesting position. I should agree with you guys there. But Lyn, we talked about plenty of stuff, pretty short and sweet so far, but in every macro trading floor episode, we're going to ask our guests to be clear about what's the macro trade. So here is the question. What's your macro trade?
Yeah, so I like energy pipelines here. And the reason is I like them on multiple time frames. So there are a number of things I like long term that I have no idea what's going to happen in 6 months. Let's say Bitcoin, right? So it's got a mild uptrend, but I don't know what's going to happen in the next 6 months, even though I like it for 5 years. But in a declining PMI environment with supply chain issues and kind of the stagflationary type situation, I want something that I like for the next 5 years, but that I also, I think has a reasonable prospects over the next 6 months, 9 months, 12 months. And so we've had a big run up in energy producers. I still don't think they're expensive, but energy pipelines have kind of lagged, and they have less overall sensitivity to oil prices. They still have some sensitivity because it can affect the producer volumes, and therefore it can affect their volumes. And in the past, you had pipeline companies blow up when you had energy price crashes. It's because they were over levered, right? So they were reliant on constantly issuing debt, constantly issuing equity. And so even if their underlying business was not impacted too much, their whole financing model was. It was basically reliant on unlimited capital being able to, being willing to buy all of their types of liabilities. And so in the past several years, you've had now two blowups in the U.S. energy pipeline space. The first one was back in the whole 2015-2016 period, and then you had another one during COVID that kind of took out some of the stragglers. And so now that the dust kind of cleared, I actually really like that space. I think it's more appropriately levered, given it's still an asset heavy business, kind of utility like. So they of course they have some leverage, but it's now back down to very reasonable levels. And I think that they're kind of well positioned here. Their valuations are totally reset. And there's a couple ways to play it. One is you can focus on the really high quality names. So for example, I like Energy Products Partners. EPD is the ticker. And they're one of the ones that never blew up, right? So they never had to cut their distribution. They never got over levered. Whenever these slowdowns would happen, they just would kind of stagnate for a couple years and then resume growing. So they'd run into headwinds, but they wouldn't blow up. Basically very well managed, very diversified. So it's not just oil, right? It's oil, it's natural gas liquids, it's petrochemicals, right? So a lot of different types of energy and refined products transporting and storing and exporting. And so with, say, Europe's energy system crippled at the moment, and basically still a long-term prospect for emerging market energy demand growth, I think that basically the U.S. is well positioned in terms of energy production and then particularly energy transport. And so I like that space quite a bit. And you can also play it with the ETF for the space, which is AMLP. So one of the downsides of pipelines is that a lot of them still are structured as partnerships, and so they issue a K-1 form. Basically, at tax season, it gets a little bit complicated, and that actually keeps a lot of fast money out of it. It keeps kind of the valuations a little bit lower, a little bit more frictions, which is really good if you're a multi-year investor. You get higher distributions, you get better compounding. But if you want to get in for 9 months and then out, then something like the ETF could be a better way to play it.
If we look at the flip side of this trade, Lyn, what would be the warning signals to get out of the trade?
The reason I picked it is because it's hard to envision a scenario where it just completely falls out of bed. But the uptrend that's been in place since the bottom of COVID could certainly kind of roll over if you had kind of a deteriorating U.S. energy production, right? So we see, for example, many energy producers are not investing heavily in capex, and you have kind of bottlenecks in terms of allowing new pipelines to be built, and so you could get stagnation in the space, and therefore you might not perform terribly, but you might, for example, underperform the S&P 500, which would be a shame. And so I can certainly envision a number of scenarios that impact it that lead to underperformance. But I think a lot of the crash risk has been removed from that space. Another thing that we're watching is how they're kind of responding. So, for example, in prior years, they used to issue a lot of equity, and they used to be building a lot of pipelines rapidly. Now they've transitioned towards a more self-financing model, so they have lower distribution yields, and some of them are actually ironically buying back their own units. Right, so they're not even issuing new units. Some of them are actually mildly shrinking their unit count, and so now you're basically expecting slower growth, but you're still expecting decent per unit or per share performance, right? So it's kind of they've rearranged where their expected returns are coming from. So a little bit higher yields due to lower valuations, and then kind of low unit growth or even no unit growth, maybe unit shrinkage, and then kind of very slow increases from inflation and other things like that they can pass on price increases. So I think it's really one of those things where most of your returns are going to come from distributions over time if you hold it long term. If you hold it short term, you have that kind of that mild uptrend in place. I think there's a decent chance on the downside that it just ends up being kind of an underwhelming trade where it doesn't really go anywhere. It's kind of dead money.
And on the upside, Lyn, what targets do you expect this trade to be able to reach over a few quarters down the road, which is your time horizon, if I understand correctly?
So I think EPD could get over 30 and trend towards the mid 30s, and I think AMLP, the ETF, I think could trend towards the mid 40s or up to 50 or so. But that's you're kind of basing it on investor psychology. What are they going to want to pay for it? So I think that they are worth those numbers now. But the question is, what will the market pay for it? And so if you have a broad market downturn, you might not hit those targets. You might just chop along. You might hold up better than the market, but you might not reach those. I think the best thing about the trade is that, it should be decent over, say, a 9-month period, the rest of this year. But it's also just a good 3 to 5 year position if you want to let it run past that. And so you can kind of choose your own time frame, whether you're a trader or an investor.
Lyn, this was a very compelling macro thesis and also a very good trade. I have to admit that I like it a lot personally. So that's really good.